Hi, welcome to Money Confidence. I'm Crystal Ockley, the Chief Financial Strategist here at Confidence Wealth, and every week I try to bring a topic to you that is the subject of the conversation. And 401k never seems to be far from conversation. So a lot of people always ask, like, when's the right time for me to switch from contributing to my pre-tax 401k and now go ahead and contribute to my Roth 401k? Because a lot of companies are now allowing that and have add that as part of the 401k benefits. Now, remember, for some of you, it might be 403b, for some of you, it might be 457, for some of you, it may be 401a. It doesn't really matter, whatever that plan is. The idea is, do I contribute to pre-tax dollar? Do I contribute to after-tax dollars? Or Roth, the Roth portion, I should say. So it really depends on what your belief is. Do you believe taxes are going to go up in the future or lower in the future? Traditionally, we've been taught that taxes are going to stay the same, so your income is going to go lower, so you should go ahead and contribute to pre-tax dollars during your working years. That way you can save on taxes, so when you retire, you have less income and you can take the money out at a lower tax rate. Traditionally, based on all the things that people thought, and on top of it, we didn't expect taxes would go up, that could all work out. The problem is I'm seeing a lot of retirees that their income doesn't necessarily go lower in the retirement years. So for example, let's just say you were making $200,000 a year in income. Your expenses were compensating for that minus what you put away in your pre-tax dollars in your 401k. So let's say $150,000 is what you were spending net in expenses or gross in expenses, whichever way you want to look at it, doesn't really matter. So when you retire, now you have to compensate the difference. If you're only getting Social Security, then you're compensating the difference from your investments to take that money out. What if you have rental properties? What if you have another maybe small or large pension coming in? So really, in everyone's situation, it's very unique, and depending on your spending needs and where you're going to take money out, your income could be similar. So the idea is, do you rather pay the taxes now, knowing the NME today, meaning you know what the tax bracket is, and preparing some tax-free dollars for the future because you don't know what it's going to look like in the future? Or you're just unsure. So a lot of us might be unsure. We don't know. I believe taxes are going to go up in the future. That's just my belief. So even if I'm at the highest tax bracket, I rather have some Roth 401k contributions because I feel like if I keep putting it into pre-tax bucket, it's a ticking time bomb. So it can be a personal preference. And if you just ask your CPA is thinking of saving you taxes for that year, they're going to always recommend the pre-tax dollars and not the Roth. My own CPA always tells me, why are you not contributing to your pre-tax dollars and why are you doing it in your Roth? And when I explain it, a light comes on and they understand, because their job is to try to save you taxes that year. They're not thinking in the future. Now, this is typical tax preparer and CPAs. You may have a forward CPA that's a tax planner that may think that way, but a lot of times just the food for thought, that basic traditional rule has always been fill the pre-tax dollars until you get retired. So if you look at your pre-tax dollars like they're the ticking time bomb of the future where your required minimum distribution could be large, that's when you want to also start looking at Roth contributions. So if you're unsure, that's why you have your team here at Confidence Wealth. Reach out to the team. They'll brainstorm with you and then see what's the best situation for you. If you're friends and family of our clients, or you're happen to come across this and you're unsure, ask for a session so you can go ahead and brainstorm about what works in your situation, because it really is about all the different buckets you have in place and what your expenses are going to look like in the future. Those investments are going to determine that income. So remember, it's all about a foundational plan. You need to see how everything is going to look like. Then you will understand the different investments that will make up what needs to happen in the future for you. If you just invest money blindly and not really understand the purpose behind it and that foundational planning, then it's going to make it very hard for you to decide which bucket to contribute to. With that said, if you have any other questions or there are different topics you want me to talk about, let me know. But I thought I would just touch base on this and just let you know that it really is important to build that tax-free bucket. And I know everyone's unique and every situation is different. So example, what if you were retiring next year and this year happened to be the highest income? Does it really make sense at that point? Maybe you'll be looking to convert while you're retired. Might be a little bit different. So that's the reason why I think it's important for you to bring it up and really start looking at ways to build your tax-free dollars, whether it's now or whether it's a plan to do it, in the next few years. Talk to you soon.